In Signal episode 15, we began our sector journey with banking and financial services, the system that pumps credit across India's growth engine. This week, in Signal episode 16, let's draw our attention to one of India's most enduring and self-fueling growth stories: consumer and retail. India's self-sustaining and unstoppable spending story. From daily essentials to premium aspirations, from kirana stores to digital-first brands, this sector captures how India earns, spends, and progresses. So let's begin with strategy of the week, then move to story of the week, then explore a fun fact, and then finally close it with a powerful quote of the week. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. India's consumer and retail sector is simply not about products. It's about progress, lifestyle, and aspiration. It matters because India's consumption is structural, not seasonal, and is shaped by four powerful forces working together. India's demographics, for example, reflect a young, upward-moving population steadily stepping into higher income and higher spending brackets. Urbanization brings more cities, deeper markets, and easier access to organized retail and modern convenience. Aspirations are shifting from basic needs to better choices, driving premiumization across categories. And digital adoption is expanding consumption far beyond geography, with e-commerce and quick commerce accelerating demand across India's tier 2 and tier 3 towns. But even the strongest engines face friction. High valuations often run ahead of near-time earnings. Commodity swings squeeze margins. Demand can swiftly shift with sentiment. And competition from global brands and digital challengers keeps everyone on their toes. So how should investors approach this sector? Diversified equity funds provide natural exposure to FMCG and retail leaders, allowing investors to participate in sectors' growth without taking concentration risk. Sectoral funds can be rewarding when cycles align, but they are far more sensitive to valuations, pricing pressures, pricing power shifts, and short-term demand swings. They work best when deployed strategically, not aggressively. And for our hands-on investors who track this space closely, should focus on companies with strong moats, pricing power, deep distribution, and margin stability across all cycles. The golden rule is for consumer and retail to be your steady compounder, and a SEBI-registered investment advisor can help you size this allocation with precision and discipline. For story of the week, let's meet Asha, a 42-year-old chartered accountant and a thoughtful long-term investor. Back in 2023, Asha increased her allocation in consumption and retail fund with the confidence that India's rising middle class and aspirational spending would drive long-term growth. But by 2024, the sector hit a soft patch. Rising input costs, overvaluations, and temporary slowdown in discretionary demand dragged her investment down by 13%. Asha decided to review her portfolio with her advisor, and together they revisited fundamentals, recalibrated expectations, and decided to continue her SIPs. They also decided to cap her consumer and retail exposure below 10% of her total equity portfolio. By 2025, easing commodity costs, a pickup in rural demand, and a strong post-festive traction lifted entire consumption portfolio, and Asha's patience paid off. Asha's journey reinforces a simple truth. Consumer demand moves in phases and is inherently non-linear. But disciplined investors who stay through the cycle participate in the full curve of recovery. Do you know the first product ever sold on Amazon India was not a book, was not a gadget, it was a dosa tawa, a perfect reminder that India's e-commerce revolution started with everyday essentials. Now let's move to the market highlights. The Sensex closed at 85,232 points, up by about 670 points from last week's close. The Nifty ended at about 26,068 points, up by about 158 points from last week's close. Markets were influenced by soft global cues, mild profit taking, and consolidation after reaching record highs. Domestic sentiment remained firm, supported by steady consumption and better earning cues. FMCG showed resilience and ended in the green. Metals, public sector banks, and realty saw notable weakness. Consumption-linked stocks held firm, supported by easing input costs and post-Diwali demand. Foreign institutional investors were net sellers, whereas domestic institutional investors continued providing steady support. The rupee ended near 89.52 per US dollar, reflecting global dollar strength and concerns around India's trade deficit. Overall, a week that began with optimism ended with caution as global softness and profit booking weighed on indices. And that was despite steady domestic consumption. And that brings us to Quote of the Week by Kenneth Fisher. If you want to understand tomorrow's markets, watch how consumers behave today. A perfect gentle reminder that consumer behavior is not a noise, it is a signal. Markets eventually follow where people spend, upgrade, and aspire. And in a country where consumption is structural and rising, these patterns are reliable indicators for long-term investors. Next week, we'll deep dive into information technology, the sector that shaped India's global identity and continues to define digital future. We are building a strong community of curious, conscious, and courageous long-term investors. If you're one of them, why not like and subscribe us and tell us in comments which consumer brand you think will continue to dominate in a decade from now and why.